Hello and welcome to episode 247 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leakes. Damien, how you doing?
Good. It's been an eventful week. I mean, I'm not going to talk about football too long, but of course, Poch was sacked, which was a sad day in Money to the Masses Towers. Justin and I, for our sins, are season ticket holders, as many of you probably know, and I was in a state of mourning for a period of time because obviously Poch gave us loads of good times, Champions League final,
trophies. Oh no, sorry, you carry on.
Which obviously was part of the problem, but it's interesting to see where we're going to go now with Tottenham. So it's been an eventful week. Slightly distracting, but on top of that, I just want to go back to last week's podcast to change the subject from football, and it was such a well-received podcast, particular to the pieces we did about decision making, but in particular the feminist economics piece that I did last week, which I'm really pleased about. It's one of those topics that I'm always nervous about covering. Not nervous because I don't think we should talk about it, but it is because I'm a man and we need to talk about these things. And it's such a topic where it's sensitive and lots of people, particularly men, might not agree with. But I got a lot of really good messages and positive feedback about the piece, thanking me, obviously particularly from our female listeners, about shining a light on the inequality out there and how the world and society in the UK in particular doesn't value women's input and the hours that they work, etc. So women are undervalued, and that message came through strong last week. So I'd like to thank you for feeding back on that episode because it meant a lot. I put it out there. I really wanted it to be well received, and it was. Now, on to a future podcast, because we're nearing our 250th episode, aren't we, Andy?
Yeah, I mean, simple maths, we're only 3 away, aren't we? And that'll be mid-December, I think, that we're due to release it.
Yeah, and we talk about what would we do, because we celebrated the 100th episode. If you go back and listen to that, you will hear we did a bit of an outtake special, didn't we, with the things that went wrong in the previous shows that you don't get to hear, because believe me, we don't do this in one take. Sometimes there are things that we mess up and laugh about, so some of that makes it onto the podcast, but chunks don't. And so we made a bit of a montage of that, didn't we? But this time we thought we didn't celebrate the 200th. What we're going to do is celebrate the 250th. And we came up with the idea is that we want this to really be about the listeners. So we want your voices. So you hear our voices week in, week out. And there are very few people who've ever appeared on the Money to the Masses podcast. I almost can count them on one hand. In fact, I think I can. And we want to have your voices on there. And to do that, we put out a request on Facebook. Join our Facebook group, facebook.com/groups/Money to the Masses. There's loads of great stuff going on in the group. So if you listen to the podcast, join anyway. But we put a post in there about the 250th episode. And what we need from you is just a very short snippet of what you like about the podcast, favourite episodes, anything you want to say, to be honest. And you can send those voice memos to Andy at andy@moneytothemasses.com. So you could do that by just getting your phone, recording it via one of the apps, maybe Notes or something like that. All the apps have an ability to record a voice note, and then you could send it to Andy via that email address. And what we're going to do is please send in your voice notes and just say your name and who you are, and we'd like to put them on the podcast. Obviously, everybody who sends one in is going to get a Money to the Masses mug. That's a given.
So it's mug-worthy, isn't it?
It is mug-worthy. And those of you who do appear on the podcast, if your snippet is on the podcast, we might put them at the beginning, the end, in the middle, or depends what you send in, then those people are going to get a limited edition mug that says that they've been on the Money to the Masses podcast. Because as I said at the beginning of this piece, hardly anyone's been on there bar me and Andy. So there aren't many people who can say they'll ever get a Money to the Masses mug to say they've been on the podcast. So we're making limited edition ones for those people and for anyone in the future who ends up on the podcast. So please do go to the post on Facebook. Do send in those messages, because I know you come to the pubs, you've done events, but don't think everybody else is going to be sending in the messages. We want you to send in messages. So send them in. and then see if you appear on the show.
That's it. Don't wait for everyone else, like Damien says. So get your voice notes over to me. It's andy@moneytothemasses.com to get your voice heard on the podcast and your chance to win that exclusive, and it really is exclusive mug. There's going to be probably less than 20, I imagine, ever made, ever. So you're really exclusive.
Yeah, I think there's probably less than 10 people who've been on the podcast, to be honest, but there we go. On with the show.
Yeah, what have we got coming up this week?
So 2 pieces on this week's podcast lead on from last week's podcast. If you remember last week, I talked about the importance of following a process when making decisions. So the decision shouldn't be judged on an outcome. It should be judged on a process, and a process that's repeatable. Of course, that, when I thought about it afterwards, then sort of leads to the question of, well, what are the processes you can use to make a decision? Because it's all well and good saying you need to have one and don't judge decisions by the outcomes. So what types of process can be used to make a decision? And then leading on from that, which is a second piece, it's about how to build an investment process. So I talked about process a lot, but how do you build one that you can follow? So there's some good rules out there, sort of a bit of a step-by-step. The third piece I want to do on the podcast this week is to do with commission that's being charged on funds. So there's a piece of research that came out to say 23% of investors are still in old style funds. And a lot of those funds will still be paying commission to financial advisors for advice they gave years ago. And investors don't realise that, and this could be amounting, well, it does amount to millions and millions of pounds that they're paying to financial advisors for no service at all. So it's a slightly outrageous. It's a byproduct of the Retail Distribution Review. I know you probably thought that trail commission had gone on investments, but I'm going to explain more on that. But more importantly, I'm going to explain the problem, but how to check that you're not being impacted. And also, if you are still paying commission to a financial advisor, how you stop doing it.
Excellent stuff. So what should we start with?
So let's start with techniques to make a decision. And there's lots of different techniques you can use out there, but there's a book that I've read, and I will promote it. It's called The Decision Book, and it's an inventive title, but The Decision Book is a very small book. It's by, I'm going to mispronounce these names, but it's Mikhail Krogerus and Roman, I think it's Czeslapilla. If they listen to this podcast, which they won't do, I've mispronounced that ridiculously, but you can find it. Andy is laughing now at my pronunciation.
It's the second one. It's the Czeslapilla or whatever you said. But it's good enough. I couldn't have done it any better, to be honest. So,
and you couldn't have done it any worse. But but the point is, this book is a really neat little book, because what it does is it has a summary of 50 different models for making decisions, whether that's in business or personal decisions. And they literally one-page summaries with pictures in there, so you can then go and explore these ideas yourself. I want to just pull out a couple of them just to get people excited about the idea of how you can make decisions. So let's start with a famous one, which is SWOT analysis. So SWOT, which is an acronym, and the individual words are strengths, weaknesses, opportunities, and threats. So this is a type of analysis that can be used to try and help make it formulate a decision or to plan where you're going to go next. So if you think about it in terms of a company, it may be them planning their next strategic move. And so to give you an idea of how this works, if you as a company, it could be a person, but I'm going to just use it as a company for now, just about decision making. You write down your strengths, so what strengths you have as an entity, your weaknesses. You then look at the opportunities that exist. So the first two, strengths and weaknesses, are internal things. So they're things that you might have that are very big positives or negatives. So it could be, for a company, your strengths could be your management. It could be the product that you have. Weaknesses might be capital or lack of capital. Then looking externally, you have opportunities and threats. So the opportunities that exist out there for the company, it might be in terms of markets. Threats, it might be competitors or anything. And this can be used, again, the versatility of it is it doesn't have to be used in business. It can be used in personal decisions. And then what you do is, after you've identified areas of the strengths, weaknesses, opportunities and threats in those 4 key areas, you then look at the strengths that you have and see how they can be used in the areas of opportunity that exist out there, and how they can be used in the areas where there's threats, so to nullify any threats that you have. Then, in terms of opportunities that exist, you then look back inwardly and think, well, the opportunities that exist out there for you as a person or a company, how can that nullify or counter the weaknesses that you have? And in doing that, what it does is it starts to help you formulate a plan of attack. And then you can make a better decision. Rather than making a decision based on what you would like to happen, you're basing a decision on something that's utilizing positives, negatives, encompassing all those things. So if you think about it in terms of what we do at Money to the Masses, we do this a lot. So strengths and weaknesses are important, both on a company level, but a personal level. So you think about me, when I talk about this at events, you will have heard me talk about strengths. I'm very aware what my strengths are, but I'm very aware what my weaknesses are. But sometimes it's your perceived weakness which actually hinders you. And sometimes that can end up being a strength. And so the opportunities that exist out there that can counter those weaknesses. So I'm going to give you a personal example of this. Is you would have heard me, if you've been to one of these events, talk about the idea that I'm not from a very posh background at all. I grew up on a council estate. I don't speak the Queen's English. All these things to me were weaknesses. And I'm not like the people I used to work with in the financial industry. There's very much a particular, you can, without me having to describe it, you can tell the particular type of person that works with very rich people in the city. But in the end, the opportunity of doing what I do now was what made me make the decision to do Money to the Masses, to carry on with it. There was an opportunity there, as in I was like the masses. I was just like everybody else out there, which by talking about money, that meant that I was talking like you would do with a friend, and that's why people like the podcast, as we talk on a level. And so we're actually the weakness, the opportunity out there compared to what I perceived was a weakness was what made Money to the Masses what it is. So the opportunity that no one else out there with the skill set that I had was talking about money and was doing it for free, giving away that knowledge. And so that was the opportunity countering that perceived weakness that I had. And so you can see the decision for me to carry on or even to start Money to the Masses in a way had an element of this analysis in it, even though I didn't sit down and rigidly come to that decision using that SWOT analysis with a grid and everything like that. But it just shows you a decision making process needs to take into account lots of things. One other way of making decisions is the consequences model. Now, it's interesting because when you make a decision, you have an amount of knowledge and then there's a consequence of your decision. So if you think of when you start something, whether it's a project or it's something you're trying to make a decision upon, you start with very limited knowledge of what's going to happen. So what will tend to happen is as time goes along, you start to acquire more knowledge about the thing that you're doing. So it might be a project. The project might be moving forward. As the project moves forward, you learn more about the nuances of what you're trying to achieve. But then the decisions you make at the beginning have a far bigger impact than the ones at the end. And what this type of thinking is trying to teach you, the consequence model, is that if you defer making decisions until the point where you have all the information that you think you need, then what happens, the consequence of those decisions is actually much lower. And the consequence model is trying to encourage you to make decisions or become more comfortable with making decisions on limited information. And it's okay to do that. So as a person, you have to start thinking, do I need all that information to start making a decision? So what it means, I like to use personal examples. So one of the decisions I've got in my life is trying to work out what we're going to do with schools for my daughter. So secondary schools when she gets there. But of course, the school that she goes to could involve us having to move house. It can involve a whole lot of things that impacts our family. If you make a decision earlier on, rather than wait until she gets to the point where we've got to fill in the form and say where she's going to go, by that point, whatever decision we make has almost been made for us, because deciding to defer a decision is a decision in itself. So if I defer, I can't actually make a bigger impact as I want to, because actually I'd be forced down a road that wasn't an outcome that I necessarily would have wanted. So in that instance, by me making a decision, do you know what? We don't want her to go to this area, or we don't want her to travel a certain distance to school. We don't want her to have to travel by train for like 10 miles or something like that.
Or maybe perhaps we don't want to have to move house.
Exactly.
Could be another one. So then that limits the scope.
And so the consequence of that decision makes a massive impact on where you're going to end up. And that's a decision making process where you go, right, let's boil it down to the big decisions we need to make first. because the consequences of those are going to be much more significant. Then you get down to the nuances of necessarily maybe the schools you like or what subjects they teach. Because, I mean, anybody going through this now will know that you go to a school, you visit them. I visited loads of them. And then you find out that they do things differently in terms of languages. Some schools teach kids all like French and German and Spanish, or they only get taught one of them depending which class they go in. And it kind of, those sorts of things, you would then say, well, I don't really like that idea. My wife speaks Spanish, so we would quite like my daughter, and she would quite like to learn Spanish. And the idea that we wouldn't choose a school because of the way they teach languages, that's a smaller decision.
Further down the line.
But if we don't make a decision, what would happen is that we would get to the point where, like you said, the brilliant example of do we move? If we wanted to, so we would be in a school catchment area. If we didn't move, by the time we've got there, the decision is too late, and then we're forced. The consequence, we can only go to a particular school, which might not be the school that she wants to go to or that we would like her to go to. But interestingly, this goes full circle to last week's podcast. If you remember, last week I started talking about my dad, and he used to do the 7 out of 10. If you can get to 7 out of 10 on a decision in terms of the things that you're happy with, this is almost a reflection of that. So you're not going to have all the information that you want in life to make a decision. But if you have a process by where you are happy, you determine how much information that you need and are comfortable with having before you make that decision, a kind of 7 out of 10, then you make the decision, and that's a process. Whether the decision ends up being providing the outcome you wanted is almost down to luck in some ways. As long as the decision making process, you have no control over the outcome is what I'm saying. But as long as the decision making process was legitimate and robust, you can't beat yourself up about it. And I'm having this, again, I'll be very personal on this one this week. I'm having this discussion with obviously my wife and I. We talk about this a lot, about to do with our children and what they might do in terms of schools and things, because we have to make decisions. But of course, if you have two people trying to make one decision, it becomes very tricky as well. So even more so, we're having to sit down and go through this. Well, how are we going to make this decision? Because we don't want to get to the point where we make a decision and then the other one will sit there and resent the decision that was made and say, subsequently, if it doesn't turn out how we wanted it to be, the school was terrible or something like that. Well, the reason the child's gone there is because of maybe I'd impose more of my view on it or something like that. So if you have a process of coming to a decision that you agree on and then you make that decision, then it is far more harmonious. I mean, I know I'm using a personal example, but decision making isn't just about money. It is also about other things in life. Equally, moving on a stage, the Pareto principle, which is what 80-20 investors built massively on, is that you get 80% of your outcomes, or it could be returns, from 20% of the input. So if you're thinking of school exams, then 20% of the work you put in terms of studying will probably yield 80% of your marks. You just don't know which percentage of that studying it will be necessarily. But the point is, again, that you need to hone in on what it is that's important, that's going to make a big difference. Kind of linking in with that consequence model, you need to work out what are the important things to focus on, and then you make that decision. And going on to investing in a way, with 80-20 investor, there is an element that is distilling it down to having less information in a lot of ways. So it's that kind of keeping it simple, because then you've got the information you need. You don't need all the headlines, all the excitable noise you get out there, or some of the misleading stuff and marketing material. You get the information you need. You know you can't guarantee the outcome, but the decision is still a process is valid. So I'll come on to investment processes later. The last thing before we move on from this section is beware of cognitive dissonance. Imagine you've got a smoker and the smoker knows they shouldn't smoke, but they do. Then that uncomfortable feeling that they have because they do smoke is that cognitive dissonance, that idea that there's a discomfort because what they're doing is they know they shouldn't be. It could be anything, it could be gambling, it could be drinking. It doesn't have to be vices. It can be just something that they know or believe, and then they act in a different way.
Me supporting Watford would be a great example of that.
Exactly.
I know I probably shouldn't, but I can't help myself. It doesn't make any sense when you actually look at it.
No. And it's a good example again, because then this leads on to biases, because what ends up happening is that what they will do is they will start to reaffirm behaviours. So they'll sit there and say, yeah, it's okay. I know that about smoking, but smoking helps me relax. So it's a self-justification, which ironically I used to smoke, as did Andy.
Yeah.
That's almost how we met, really. We didn't. It was working somewhere, but we did used to have the odd cigarette break together. But smoking doesn't actually relax you because it's a stimulant. Nicotine's a stimulant. But what can happen is that even when you make a bad decision or you make a decision that you know isn't optimum, you will try and justify it, and that's so you can sleep at night. So all you have to do is be aware of these things, because it can lead to decisions where there is only ever going to be probably a negative outcome that you even know, because you'll try and justify it. And that's because we are all humans. We've got to be aware of biases, and I'm not going to go through them all now, because if you go back to podcast 185, so that's your homework this week, I did a whole podcast about the biases that exist in human behavior that particularly impact investing. So it's the same for decision making. So I'll run through 5 of them, just list them really. Loss aversion, we touched upon that last week. Overconfidence bias, confirmation bias, that's a good one. So that's
you focus and obsess about the things that prove your theory.
Yeah, so it would be like you looking up the fact that Watford are a great side and they're bottom of the league, even though you're ignoring the fact they're bottom, but you're only looking for the things that Watford
previous
are
successes.
Yeah, and they're a big side and stuff like that. Sorry, Andy, I don't mean to laugh. I could be saying the same thing about Tottenham, but it's the same thing. A good example this week, I've been reading loads about how Jose Mourinho is going to turn around Tottenham, despite the fact he's been sacked from his last 2 jobs, and all the positives that it could come from this, because I really want to believe it. But I know I'm being a fool to confirmation bias. I'm looking for the reasons to believe this is going to be a good thing. But often you don't have that consciousness. You just need to be aware of it when you're wanting markets to rally and they're being weak, and you're looking for the articles that go, yeah, this one says that it's going to be very positive and we're going to have an uplift. Just be aware that you are falling foul of confirmation bias. You're looking for things that reaffirm your previously held belief. Anchoring is a good one. The idea that you anchor yourself to a particular value or point in time. On investing, it could be the price you bought your investment at. And as I say, listen to the podcast. It explains more why that's a problem. And hindsight bias. So hindsight bias is one where if you have a favourable outcome, so it again links nicely to what we talked about last week when I talked about the difference between dumb luck and bad luck, and about having a process. If you have a positive outcome, the hindsight bias is that you would say, yeah, I knew what I was doing all along, and you believe it. So go back and listen to podcast 185. There's lots more about it, but that will help you make better decisions, because it will help you avoid these biases and be far less emotional when making decisions. The key thing on making decisions, money otherwise, is trying to minimize the emotion in the decision-making process.
Good, and that kind of moves us on to the next part of this, is the second part of the podcast, but it links in well. It's how to build an investment process.
Yeah, so it doesn't matter what your investment process is. I'm not here to pitch a process to you and say, I know I do 80-20 investor, but some people have different processes. It may be they invest in a particular style or the way they choose them. There is no one way that works every time, and that's the beauty of investing. It's that uncertainty that exists that allows you to be able to outperform it from time to time. And so whatever your process is, if there was one perfect way, Andy, let's be honest, everybody would do it, and then it would actually therefore not exist anymore, because if everyone did it, then by definition, then if everyone's doing one thing, you can then manipulate that. So it doesn't exist.
And I hear the phrase, every dog has its day. That's quite key in investing, with the way things move.
And styles, every dog, that could be fund managers or investment styles. At the moment, value investing has been picking up in the last couple of months. If you listen to the Midweek Markets podcast or show, you will hear me talk about that, and that's because the narrative of markets have changed. But anyway, I want to go through the steps of building an investment process. There's largely 3 really. Whatever you do, whatever your investment process is, you need to be able to write it down. And so your investment strategy, therefore, is a process. You should be able to write it down succinctly to explain it. And that whole keep it simple, stupid, that KISS acronym, I always remember my old maths teacher saying that to me, that acronym, and I think it served me pretty well, and it works in investing.
Yeah, I haven't heard that one before, actually. KISS, keep it simple, stupid.
Yeah, and the next thing is to think about, does the process match your long-term objective? So by that I mean, if you've got a process that is constantly fixated on the short term, so it could be on the nuances of day-to-day moves in stock markets or something like that, but you might be a long-term investor, then there is a slight mismatch. Or perhaps a better example is if the things you're buying are not trading day to day, then you don't want to be obsessed about day to day movement. So like, for example, unit trusts are a good example of that. You can't trade them minute by minute. They're priced singly every day. So you want to be in them for a while. So you don't want your process to be something where it says if your investment's up or down today, then you get out of it. If you're using unit trust, for example. So you've got to be able to write it down as a process. Leading on from that, I quite like the idea that you should be able to write the process down on a sort of back of an envelope. And I mean, I theoretically could with something like 80/20 Investor, despite all the number crunching and everything that goes on, the process of what I'm trying to do and how I do that, I could probably write it down the back of an envelope without any doubt. Let's be honest, I think the atom bomb was written down on the back of the envelope when the equation that did that. So it just shows you it shouldn't be something that's overcomplicated. And the lead on from that is it means that it can be automated. So you could get somebody else to automatically do it. If you can't, then you have to question why. And if there is a why and there's a reason, it's likely that there's an emotion that's becoming involved in your process. So to go on to the next step on this is, what is your process? What is it exploiting? So if you've got a process, what is it trying to exploit out there? So momentum is a good example. There are 3 styles of investing. I've talked about it in the past that have been shown to work over the longer term: value investing, momentum investing, and smaller companies investing. So value investing is investing in unloved sectors and shares and funds that you hope that have been undervalued because the market didn't place the value they should have on them. And then when the narrative change or when the market participants catch up, there's a mean reversion and you ride that wave up. Smaller companies investing is simply you get small companies that turn into tomorrow's big companies and you ride that wave. Whereas momentum is, as the name suggests, you're riding the things that are going up. All of those things are exploiting something in particular. So the value is the unloved element that you knew something the market didn't. Momentum, you're exploiting a trend that is rising, so you're going to ride that despite that people might not like that investment. In smaller companies, it's that trend of growth that over time that smaller companies might get to bigger ones, but you know which ones, you might have a particular understanding of that. Those are processes that exploit things. There are others you could have, so you could be trying to exploit some sort of market inefficiency in the style of investing you do, whether you're buying shares directly. It might be something that you might know or you might work out that you're trying to do. Particularly, you might get this in people who are trading different sort of commodities or different types of assets. And I think cost is actually one. I don't think there's anything wrong with the process being that you buy and hold certain types of investment, whether it's even passives for a longer term. There's a process there, how you're getting to make decisions, how you're deciding what assets to hold. So there's nothing wrong with that. And the final thing is, I think you have to know when your process will perform well and more importantly when it won't. So you will have periods of underperformance, as we said earlier, because nothing works forever. And you're going to have periods where dumb luck, if you don't have a process, would also work, so you'd actually do well. Or if the process is actually a valid process, like we said, some of the others we've mentioned, it underperforms and is bad luck. But you need to understand why it behaves like it does, because then you can make that judgment call on whether there's something wrong with the process or whether it's, like I say, it's bad luck. And it also, more importantly, helps you maintain conviction with the investment process. So the message is, whatever your process is, if it's throwing darts at the dartboard or something like that, I don't know what your process is, it should be able to be repeatable, it should be able to be succinct, be able to write it down, it should be able to provide results that you can look at and analyse, and you understand when it will perform and when it won't. And unfortunately, throwing darts at the dartboard doesn't actually fall into those categories quite quickly. So that is taking the whole decision making. It kind of finishes off last week's podcast quite nicely, I think.
Okay, so moving on to the last piece, and we mentioned at the start of the podcast we were going to focus on commission and trail commission and what people can do to find out whether their investments have an element of that and what they can do about it.
Exactly. So what happened is there was a piece of research that came out this week. 23% of investors are in older fund classes that could still be paying financial advisors commission. Now, people who listen to this podcast will know or might know that there was something called the Retail Distribution Review that happened on the 31st of December 2012. So it was a big piece of basically rule changes that came in. around the way that financial advisors were remunerated. There's a whole range of things that were impacted, but one of the biggest things that came out of that eventually was to do with financial advice and investment commissions. And I'm going off on a slight tangent, but it is also part of the reason why we have such a big advice gap at the moment. People can't afford advice. But just to give you the setup, previously what would happen before RDR, you might be a consumer who goes to a financial advisor. The advisor recommends you a stocks and shares ISA or an investment. It'll have some funds in there, and then you'll pay a hefty upfront commission in most cases. Then they would agree a trail commission that came out every year. So it was a fee that was meant to pay for their service or ongoing advice. In reality, it was about 0.5% in most cases, could go up to about 1% a year. But it was like 0.5% was typical. The reality was that was just a great way of them just creaming off your investments forever. And so 0.5% a year is a lot. And that was just the industry the way it was, which is partly why RDR came in. And the idea was that it all had to be a bit more explicit about these charges. So there were new clean funds that were created. So to give you an example, you could have been in, let's call it Fund X before RDR. And part of the charge that was paid, so let's just use round numbers of 1.5%, maybe 0.5% of that annual charge, so 0.5% of the 1.5% would go to a financial advisor, your financial advisor who'd given you advice. Now, that's quite a bit of money. Going forward, what would happen is that you were put into clean share classes, which were like, say it was 1% a year after RDR. But then you might agree with your financial advisor to pay them directly from your investments that 0.5. So they were still getting paid, but they had to be an explicit agreement that you said, yep, deduct this separately from my investments, which obviously therefore gave a lot more transparency and therefore power to consumers if they didn't want to pay for that ongoing service. Now, the idea was that this trail commission still existed in these old funds. So if you imagine if you'd had advice before 2012, which a lot of people will have done, still have the same investments, they were still in these old funds. So Fund X, they were still in the old version. It's exactly the same fund as the new version of Fund X. So we're going to call it Fund X, but the clean version. It's the same assets. It's the same run by the same fund house, but the charge on one is cheaper. The issue has been that over time, while the general costs of funds have started to fall, the difference between the old Fund X and the new clean version of Fund X, which didn't have this built-in commission for financial advisors, was 0.5%. There's that difference. So it's still now, it's 0.5% more they're paying in the clean share classes. Now, where we are is that the FCA started to create rules about moving people into new clean share classes. So they go from the old Fund X to the new clean one because that would be better for them. The issue came that asset managers, so the fund houses, couldn't be moving people from the old version to the clean version automatically if they'd had advice previously. So lots of people were moved across from the old ones to the clean share classes. In fact, if you go to most platforms, very soon afterwards, you could only buy the clean version. So it was positive. People were moving into the new world where it wasn't all bundled up. Costs were a bit more explicit. The problem is that these 23% of funds, people are still in the older, more expensive versions of these funds, and they could possibly still be paying financial advisors commissions all these years. And that's because, like I say, the asset managers can't automatically move you across. Because what would happen, an asset manager could move someone from the old style fund, Fund X, to the new clean version. Like I say, it's just a movement of across to this clean version. It's the same investment. Give them 60 days notice, but they can't if they'd had advice. So that was the issue, that when this research was put out, when they work out the numbers, that's a lot of potential commission. And you have to understand, obviously, financial advisors, some of them in the past will have built up a big book of this commission in the background. And then some of them would argue that it's because they didn't take much up front and it was built into like almost working out like an annuity for the business, like an ongoing amount of money. And they've been sold on to other businesses. Maybe they've retired as a financial advisor and that book of clients has value and they've been able to sell their business. So that's why I think it was about 18 months ago, the FCA agreed not to just say outright ban past commission. They could have done that. What the FCA could have done in theory is just said, look, do you know what? We're going to move everybody across to the clean funds and ditch old trail commission, but they decided not to, which obviously the industry, the advisors were pleased about. So this is an FYI. If you have old investments that you've had for a long time, you could be in an old fund, an old share class of that fund that you could move across into a new one if you wanted to, and you'd be saving money. Now, the reason I point this out is because if you invested 100 grand over a 30-year period with a 6% return, if you had a 1% charge, annual charge, so that was the fund charge, the clean share class, then you would have, after 30 years, £426,640, meaning you'd paid 67 grand, just over, in charges. If you were in the old style share classes, which, as the research showed, still are more expensive, ignore the trial commission element, just more expensive anyway, up about 0.59%, so 0.59% more. So if you run the same numbers I just said, 100k over 30 years, 6% return with a 1.59% annual charge, you would end up with £358,000 having paid 95 grand in charges. The difference is that you would have £68,224 less in your pot, despite in both of those scenarios you'd be invested in the same fund. It's the same fund, but just charged differently. So if you've had investments that were before 2013, go to your platform, get your paperwork on your investments, and check the ISIN code, and go and look at the charging structures on these funds.
When you say ISIN code, ISIN, right?
Yeah, so it's like the number plate of a fund, and therefore you know exactly every share class of every fund has a particular code. So you know if you said, I don't want to just use particular companies, but if you said Invesco Perpetual Income Fund, there will be different share classes for that fund, and they could be charged differently. Now, if you find that you are on a more expensive version of your fund, then you could switch across to the cleaner version, the cheaper version, and it's worth you doing. Now, if you are on a platform, then in all likelihood, what happens, even if you're in the old style fund, they are actually rebating fees back to you for if you're a client before 2014. So you want to check that that's happened, but you want to move across to the clean one anyway. So there is some good news, but it's people who are in old legacy funds that might not be on a particular platform. But even if you do get the rebate from a platform, you could still be on a higher charge, as that research was suggesting, because, as I say, it's not just about the commission, the charges, which is generally higher as well. So if that's the case, you see your platform is charging you more for the share class, and they do have another version of the same fund with a different share class, but cheaper, then ask to be converted. If you want to move, make sure you ask the platform to convert from one to the other. You don't buy and sell, because if you convert, then there's no implications from tax perspective. And for a lot of platforms, there's not from a cost perspective either. So, for example, Interactive Investor, a platform that charge for fund switches, but they don't for a conversion from one share class of a fund to the other or another share class of the same fund.
Got it.
A lot of fund platforms don't charge fund switches anyway. There are people like AJ Bell, for example, who regularly sweep through people's portfolios looking for these old style funds and then moving them across to the new style, cleaner version funds. And even to the point where if you transferred to that platform in particular and you had old legacy style funds, then they would, once your transfer came across, they would then move you into the cleaner version.
They pick it up automatically and just do it.
Yeah, so the message is check with your platforms. Overall, the summary is people who've had funds for a long time where they received advice, there's a chance that you are paying over the odds for your fund, and there's also a chance that you're paying a commission to a financial advisor, but you can do something about it.
If somebody does do that, is there any chance that they could get contacted by a legacy advisor and say, hey, I realise I'm not getting paid on this anymore? And should they feel bad?
No. I mean, they should be having a service anyway, so I would say no. And because of the time that's gone by, then the chances are if you didn't know about this, then it's a case that the advisor's probably not giving you any service anyway. And I don't think you should do. The trial commission ends up being basically a tax on your return. So you shouldn't feel bad about it. Ultimately, you're paying over the odds and it's your money. And if you think about that 68 grand I talked about, that is the expensive version of investing in the same fund, then a portion of that could be going to a financial advisor, and why should it?
Okay, so that's it. We're all done. If you want to get in touch with us, please do so. It's Damien@moneytothemasses.com. You can get in touch on Twitter. It's @moneytothemasses with the number 2. We're also on Instagram. Don't forget about the Facebook group. That's facebook.com/groups/money to the masses. And do please get in touch if you've got any voice memos, if you want to give us any messages of support, thanks, just anything really, because it's our 250th, it's a celebration episode. It's your chance to get your voice on the podcast, and if we choose you and get you on the podcast, you'll get an exclusive mug as well.
That's it. So I think that's it for this week, Andy.
Until next time.
Until next time.